Alright, so this is problem 738 that we were going to do in class, but ran out of time. And so on this first tab, I just copied in the information from the book, and then on the second tab, we'll have our calculations. So in this one, we have Rossmann Corporation holds 75% of the common stock of Schmid, I guess? Sure. And they purchased it back in 2001. They give us the price of $2.3 million. They give us the subsidiary's common stock and retained earnings on the day that it was purchased. And let's see, it gives us the value of the non-controlling interest, and we have it actually tells us what the differential is broken out, makes it nice and easy. So we also have where the parent sold a plot of land to the subsidiary, so we had an intercompany gain, and so there's going to be consulting services going back and forth for $80,000. And then we have some more intercompany transactions for $20,000 here. There was also, on the first of the year, the parent paid $250,000 to purchase equipment from the subsidiary for $290,000, and it gives us the subsidiaries what they I guess that's what they paid for it. And then so we also have the trial balance as of the end of 2008, and then it also tells us down here that the subsidiary declared dividends but didn't pay $5,000 related to the fourth quarter. So okay, so we have all the information here, and then the first thing it asks us to do is compute the amount of the differential as of January 1st, 2008. So over here we have the differential on the day that we bought it, but this was way back 7 years ago. And so we want to calculate that differential actually as of the beginning of the year that we're talking about, which is 2008. So if we go over to the calculations tab, brought over the trial balance to make it a little bit easier to calculate numbers, and then we just kind of summarized like we usually do on the board some of the data from the problem. And so if we go here to part A, we want to calculate what that differential is today. And so okay, so it tells us what the differential was when we started, when we bought it, and that's $150,000. Now we have to adjust that for things that are going to change those differential items. So, what's going to change inventory, what's going to change land, what's going to change goodwill. And so what changes inventory is if we sold it. So we want to go ahead and reverse out that inventory that we sold. And so the other two items that could affect this is if we had any depreciation or amortization. And so land and goodwill, we don't depreciate or amortize, so that's going to be a 0. Or we have goodwill, and was that goodwill impaired? And it said the goodwill was not impaired, so there's no adjustment there. So the differential as of starting of the year that we're talking about is $120,000. Alright, so part B says verify the balance in the parent's investment account as of the end of the year. So over here in the trial balance, it gives us what the ending investment is. Excuse me. And so part B just wants us to actually figure out how we came to that number. And so we'll start by entering in the subsidiaries' equity accounts. And so that's going to be the beginning retained earnings, which is 1.4 million. Then we want to add net income. And so let's go ahead and just calculate what our net income is for the subsidiaries. So we have our sales, and we want to subtract out expenses. So subtract out our cost of goods sold, subtract out depreciation, subtract out any other expenses, and then in this problem it also says other income or loss. So we have a debit to an income loss account, so that is going to be a loss. So our net income for S is going to be 110,000. So we'll just link that up. And so the next is we want to subtract out any dividends. And so they had 20,000 in dividends. And so that's going to give us the ending retained earnings for the subsidiary. And then we just want to plug in their common stock, which was $1 million, one more zero, and their additional paid in capital, which was 1.35 million. And so that gets us to the total equity, but we only own 75% of the subsidiaries. We want to take the total equity and multiply it times what the parent's share is. And so now we want to, that's all the book value adjustments, and now we want to adjust for things that are outside that book value. And the first is going to be that differential on that we calculated up here. So that is going to be our 1.2 million, or 120,000 times 75%. So now we want to back out the gain that's related to the sale of the land. And so that land, so the parent sold the land to the subsidiary. So that's a downstream transaction. And so that means that we're actually going to have to back out 100% of the land. And so there's also equipment that was sold between the two. And let's see. So the subsidiary sold it to the parent, and so that's going to be an upstream transaction. And there's going to be a loss related to that because it says that the carrying value was 290,000. But we sold it for 250,000. So put these in parentheses. So the subsidiary took a loss, and the parent's share of that loss was 75%. So we have to add back that loss because it really didn't happen. And so the next is, since the subsidiary sold equipment up to the parent, it stopped depreciating that equipment. And so that unrecorded depreciation, we're going to have to go ahead and add that back. And so the difference Alright, sorry about that. I keep getting text messages while I'm trying to do this. It's distracting. So anyway, so what happened was we sold equipment that had a carrying value of $290,000, and the parent now has it on its book at $250,000. So that means we're not depreciating enough. So what's being depreciated now is on a basis of $250,000, but it should have been depreciated on a basis of $290,000. So what we need to do is we need to take that difference, which is that $40,000, divide it by the remaining years, which is 10, and then multiply it times our percentage. And since that's depreciation, that should be negative. So that gets us, hopefully, to, yep, okay, good. So the ending account balance in the investment account is 2974. We got 2974. Good. So we identified everything that went into that in or out of that investment account. Okay, so I'm just going to shrink the trial balance over. And so, okay, so now we have part C, and so now we just have to do the consolidation journal entries. And so we'll start off by doing the book value calculations. So actually, I'm going to unshrink the trial balance because we probably want that, and I'm going to shrink these two. There we go. Oops, that doesn't look. There. That'll work. Alright, so we want to go ahead and fill out our book value calculations. And so we're just going to enter in the equity from the sub. So we have $1 million in common stock. We have 1.35 in additional paid-in capital, and we have 1.4 of retained earnings. So now we just need to divide that between the non-controlling interest and the parent. And then we need to, let's see, oops, gotta lock all the cells. There we go. That's better. Okay. And so that's the beginning equity. And now we want to plug in net income, which we calculated over here at 110, and then we want to subtract out dividends, which are 20. Let's just split that. Split income between the parent and between the subsidiary, or the non-controlling, sorry. And then we'll split our dividends between the parent and the non-controlling. Alright, so now we have our book value calculations done, so that'll be helpful when we do our journal entries. But now we want to do a few adjustments to that, because our basic journal entry got a little bit more complicated with these interrelated like losses and depreciation related to the intercompany transactions. So let's carry down the net income. And then we want to adjust net income for the loss that we had on the equipment. So the total loss related to the equipment was $40,000. So now we just need to split that between the parent and the non-controlling interest. Now we need to subtract out the depreciation that should have happened that didn't. And so the total depreciation is, we take that 40,000 and divide it by the remaining useful life, so that's 4,000. And then we just multiply that times the share, each person's share. It's going to be a negative because we're increasing the amount of depreciation. Alright, so now we have the amount of income that we're going to drop down into our basic journal entry. So now we want to adjust the book value to know how much we need to reduce our investment account and the non-controlling interest by. So let's just carry those numbers down. And we're adjusting that by the same things. We're adjusting it by the loss, and we're just adjusting it by the depreciation. So we can just carry those numbers down. So okay, so we have our book value calculations and our adjustment to book value, and so that's going to help us actually do the basic journal entry. Alright, so we enter in common stock, which is up here. We enter in the additional paid in capital, and we're also removing the retained earnings beginning. We want to remove the income from that we received from subsidiary, and that's what we calculated here in this adjustment. So we're going to remove 109,500, and then same idea with the non-controlling interest. Now we want to remove the dividends, and then now we want to remove the investment accounts. And good deal, we have a little check formula here. Make sure that just make sure that we're in balance. So okay, so we balance. And so the next thing we want to do is do a reclassification of that differential. And so what we have left of the differential, which we had, let me expand that. So we had our differential of 150, which included inventory, land, and goodwill. Inventory is now gone because that's sold, so we just have to reclassify land and goodwill. So that land was given to us with a value of 56,000. Goodwill was given to us with a value of 64,000. And so now we just want to split that between our investment account and the non-controlling interest. So we're just going to add these two together and multiply it times our 70%, 75%. And same idea with non-controlling interest. We're just going to add those up times our 25%, and we're still in balance. Good deal. So next thing we want to do is eliminate the services, and so that was the consulting that they did back and forth. And so the problem told us that it was $80,000 a year. We also want to get rid of intercompany payables and receivables, and so it told us that there was $20,000 outstanding between the two, so we have to get rid of that. And also it mentioned that there was dividends that were declared that were not paid out, and so they said that the total dividends declared not paid out was $5,000. However, all of that is not intercompany, only the share that's going to go to the parent. And so that's going to be 75%. So that's the payable and the receivable that we need to remove. And so next we have to remove the gain on the land, and they told us that was $23,000. Now we have to remove the loss on the equipment. And so they said that the equipment on the subsidiary's books was listed at $435,000. Now the parent bought it for $250,000, so it's on the parent's books for $250,000. So we just need to book that difference. And so then there was a loss related to that equipment, which we already calculated up above at $40,000. Actually, let me just punch in the formula. So we had a carrying value of $290,000, and it was sold for $250,000. So we had a loss of $40,000. And then we had accumulated depreciation, which was related to that equipment, that we need to put back on the books. So original value of $435,000 divided by its original useful life of 15 years, and they had it on the books for 5 that we need to put back. Make sure we're still in balance. We're still in balance. Good deal. And so the last journal entry we have to do is we have to record that depreciation that didn't happen but should have. And so we had that difference of $40,000, and there was 10 years left to depreciate that $40,000, so that's $4,000. So, and that is all there is to it. Not nearly as bad as the inventory transactions, but still a lot of steps and a lot to get rid of. So anyway, I hope that helps. And if you guys have any questions about that, just shoot me an email. So all right, thanks.